Hello everyone. We were discussing ratio analysis and interpretation of financial statement. And today we are diving into the one of the most important and frequently tested category, that is profitability ratios. Now, my friends, profitability ratios are the heart of financial analysis. Investors, managers and analysts all focus on these ratios because they provide a clear picture of how well a company is performing financially. These ratios reveal whether the company is earning enough profit from its sales, assets, and invested capital. These ratios help answer key financial questions such as how efficiently is a company converting its sales into profits? Is the company generating a good return on its assets? Are shareholders receiving a sufficient returns on their investments? These questions are critical for both investors and the management because profit is the reason businesses exist. Alright, now let's begin with the first profitability ratio, that is gross profit margin. The first ratio that we are going to discuss today is the gross profit margin, in short GP margin. This is one of the most straightforward and commonly used profitability ratios. This ratio is calculated by taking your gross profit as the numerator and dividing them by sales and then multiplying the answer by 100. The gross profit margin tells you how much gross profit is generated as a percentage of a sale. For instance, if you calculate a gross profit margin of 20%, it indicates that for every $100 of sales, $20 is a gross profit. This could be 40%, 50%, or any other percentage depending upon the company's pricing strategy and the cost structure. However, gross profit is not your final profit, but having a higher gross profit margin increases the likelihood of achieving a strong net profit. My friend, gross profit margin specifically denotes product profitability. A lot of time students make a mistake by relating the GP margin to administrative expenses, but that's incorrect. GP margin focuses only on the profitability of the products sold, not overall expense management. The idea is that a high gross profit margin provides a potential for a good bottom line as well. For example, a company has a negative GP margin of 5%. Now this means its products are being sold at a loss. So if you are selling at a loss, how can you expect to run a profitable business? It's nearly impossible for the business to generate overall profit. That's why having a strong GP margin is a must for all the companies. Even if a business is not making a substantial net profit today, a good GP margin ensures that as the sale volume increases, the profitability will improve. This is because as the sale increase, the impact of fixed cost like rent, salaries, and overhead expenses become smaller, improving the overall profitability. However, if a company has a negative or very low GP margin, survival becomes extremely difficult. Now, one of the most common misconceptions about GP margin is that higher sales volume improves GP margin. But let me clarify this for you. Volume has no direct impact on the GP margin. Many people mistakenly discuss about the volume when discussing the GP margin, which is incorrect. For example, imagine a company sells only one product at a selling price of $100 and the production cost is $60, resulting in a gross profit of $40. Here, the gross profit margin would be 40%. That is 40 divided by 100 multiplied by 100. Now, if the company doubles its sales volume, selling two products instead of one, both revenue and cost would be double. Revenue would be $200 and the production cost would be $120, resulting in a gross profit of $80. However, when you calculate the gross profit margin in this case, it still comes out to be 40%. 80 divided by 200 multiplied by 100. This demonstrates that the GP margin remains unchanged at 40% despite the increase in volume. This example shows that volumes do not inherently affect the GP margin. Thus, when the GP margin increases, it is most likely due to change in selling prices or the cost control. For instance, if the GP margin is increasing, it could be because the company has successfully increased its selling price or has become more efficient in controlling its cost. Possible reason for cost reduction might include receiving bulk discount from suppliers, reducing operational cost, or decreasing the production cost per item. Therefore, discussion around GP margin should focus on changes in selling price or cost management rather than sales volume. This is a critical concept and I want you to remember this when analyzing GP margin changes in your exams or in your real life. My friends, this gross profit margin, GP margin, is an effective tool for benchmarking and comparison, both against direct competitor and against the past performance of the same company. For example, if your GP margin is 30%, while your competitor's GP margin is 20%. Now, this is an ideal case for investigation. You need to understand how and why your company may be performing better, perhaps due to efficient production cost, better pricing strategy, or a combination of both. This comparison gives you an insight into the company's competitive position. It provides you a clear picture on whether you are performing better than your competitors or if there is still some room for the improvement. Similarly, comparing your GP margin with past performance of your own company is also insightful. For example, if your GP margin was 10% in last year and it has dropped to 5% this year, it's a red flag. Something is wrong and you need to analyze why GP margin is declining. This comparison indicates that something in the pricing strategy or production might not be working as effectively as before, and this should be investigated to identify the potential reason for such decline. Now, let's discuss the possible reason why GP margin might change. It's important to differentiate between accounting reasons and the business reasons, both of which can influence the GP margin. Sometimes, GP margin changes not because of change in actual performance, but because of accounting classifications. For example, suppose the company reclassifies some expenses, some cost from other expenses to cost of sales. This makes cost of sales artificially higher, leading to a lower gross profit margin, even though the business fundamentally have not changed much. Suppose in the previous year, company reported sales of $100 and a cost of sales of $50, resulting in a gross profit of $50. Other expenses amounted to $20, leaving a net profit of $30. The GP margin in this case would be 50%. 50 divided by 100 and multiplied by 100. In the following year, in the next year, let's say sales remain unchanged at $100, but the cost of sale rose to $55, decreasing the gross profit to $45. If we assume the other expenses are $15, the net profit remains same at $30. However, GP margin would be now 45%. 45 divided by 100 and multiplied by 100. This reduction in GP margin might initially suggest a less efficient operation, but one possible reason for the change could be reclassification of expenses. For instance, If certain cost of $5 previously recorded under other expense are now included in the cost of sales, this would directly impact the gross profit and consequently the GP margin. While the overall profitability remains unchanged, the shift affects how financial health is perceived based solely on the GP margin. If such reclassification is part of the scenario given in your exam, it is essential to acknowledge this accounting practice as it could distort, as it could affect the comparison year over year or against industry benchmark. On the business side, changes in GP margin might result from number of business reasons. For example, if raw materials or labor or production overheads becomes more expensive and the company does not increase its selling price, GP margin will decline. Moreover, changes in the supply chain or fluctuations in availability of raw material can also lead to changes in cost structure and affect the profitability margin. Also, the presence of intense competition can restrict your ability to raise the prices. If a new competitor enters the market with aggressive pricing strategy, this can force the existing players to lower their prices to maintain their market share, thus reducing the GP margin. My friends, a low GP margin might not always signify a problem. It could be a part of deliberate strategy. For example, if your company adopts a market penetration strategy, selling products at a lower price to attract more customers, the GP margin may be lower in the short term. This approach can be risky, but may lead to increased overall profitability through higher volumes. Also, some industries are regulated by government. For example, if government controls the prices, this can prevent companies from charging higher prices, directly impacting their gross profit margin. In summary, GP margin is crucial in understanding product profitability. A high GP margin indicates strong pricing or cost efficiency, and a declining GP margin can be due to higher cost, competition, or pricing strategy shift. In practice, when you notice a change in GP margin, it's critical to analyze both the accounting treatments and the business reasons to get a full picture of what's driving those changes. This holistic view helps in making more informed decisions about strategic adjustments needed to improve the profitability and the competitive positioning. Alright, my friends, that was gross profit margin, the first profitability ratio. Next, we will move on to another key profitability ratio, that is net profit margin. This provides an even deeper insight and analyze the company's overall profitability after all the expenses. Now, we have already discussed gross profit margin, which tells us how much gross profit is generated from the sales before considering operating expenses. But as you know, gross profit is not the final profit. There are many other expenses that need to be deducted before we get to the company's real profitability. And this is where net profit margin comes in. Net profit margin, also called operating profit margin, measures the percentage of sales that remain as profit after deducting all the operating expenses such as selling expenses, administrative expenses, research and development cost, and other general overheads. It essentially shows how efficiently the company converts its sales into operating profit. Net profit margin is calculated by dividing the profit before interest and tax by the sales, then multiplying by 100. Here, profit before interest and tax is used instead of net profit because interest and tax are external factors that vary from company to company and are not directly related to the operational efficiency. This ratio tells you how much operating profit is being earned as a percentage of sales. It essentially measures how much net profit is generated from each dollar of sales. For example, if a company's net profit margin is 10%, it means that for every $1 of sales, after deducting all operating expenses, the company retains $0.1 as operating profit. A strong net profit margin indicates good cost management and operational efficiency, while a low margin suggests poor expense control or operational inefficiency. Once you have calculated net profit margin, the next step is interpreting the results. There are multiple ways to analyze this ratio. You can make several comparisons to gain a deeper insight. Comparing your net profit margin with competitors can show whether your company is managing cost and pricing better or worse than others in the industry. If your net profit margin is higher than competitors, it suggests better cost control or pricing power. And if your net profit margin is lower, it could indicate inefficiencies or excessive expenses. In the same way, looking at past net profit margin trends within the same company tells us whether profitability is improving or worsening. If net profit increases over time, it suggests better cost management or improved revenue generation. And if net profit margin declines, it may indicate rising cost, competitive pressure, or ineffective management strategies. Also, comparing net profit margin with the industry average can tell us whether the company is performing above or below the standard level in the market. If a company has higher net profit margin than the industry average, it might have a competitive advantage. And a lower than average net profit margin could mean inefficiencies, higher cost, or pricing pressures. Comparing actual net profit margin against budgets or targets helps companies assess whether they have achieved their financial goals or if there are areas for improvement. This holistic approach to analyze net profit margin provides a comprehensive understanding of the company's profitability relative to the various benchmarks. Now, my friends, let's talk about the key factors that can impact a company's net profit margin. There is a direct correlation between the gross profit margin and the net profit margin. If your gross profit margin is declining, it is likely that your net profit margin will follow the same. This is because if you are not making sufficient profit at gross level, that is after accounting for all direct cost of goods sold, it is unlikely that you will achieve a healthy net profit after all other expenses are accounted for. This trickle-down effect means that GP margin is a leading indicator of whether the company's net profit margin will improve or deteriorate. Net profit margin can serve as a tool for measuring management efficiency, particularly in terms of administrative performance. For example, if the net profit margin has improved from 5% to 10% within a year, this might indicate that the management or the administrative operations have become more effective. An increasing net profit margin suggests that management has successfully controlled or reduced indirect costs such as selling expenses, general and administrative expenses. However, if net profit margin declines, it may indicate poor cost control, increased operating expenses, or inefficient administration. This margin provides insight into how well management is controlling non-productive cost and maximizing operational efficiency beyond the production stage. Unlike gross profit margin, which focuses only on selling price and the direct production cost, net profit margin also evaluates how well the company manages its indirect cost, such as selling and marketing expenses, administrative cost, research and development expenses. If these costs are not properly controlled, even a strong gross profit margin would not result in a high net profit margin. Now, when commenting on or analyzing the net profit margin, it is essential to differentiate between accounting factors, that is how income and expenses are recognized and classified, and business factors, that is strategic and operational decisions that impact the overall revenue and the cost structure. Sometimes a change in net profit margin is due to accounting adjustment rather than actual business performance. This could include one-off items or one-off events. One-off items can significantly influence the profit before interest and tax and may not reoccur in the future years, but they can dilute your overall profitability for the current year. For example, if there is a significant impairment loss recognized due to some economic crisis or some natural disaster like an earthquake, fire or flood, such one-off event may lead to higher impairment losses and declining the profitability, and the net profit margin for the year will also decline. Now, when such one-off event occur, it's important to assess whether they should be included in the net profit margin calculations or not. In many cases, it might be more informative to exclude these one-off expenses, to exclude these one-off costs to show the real underlying profitability. For example, if there is a profit before interest and tax of $10 million and an impairment expense of $2 million due to uncontrollable event like an earthquake, this $2 million would adversely affect your profitability. However, because this event is not likely to reoccur in future and is uncontrollable, excluding this impairment loss from the net profit margin calculation could provide a clearer picture of the ongoing management performance. Also, besides impairment, other significant gains or losses from disposal of asset or fair value gains and losses should also be considered for exclusion. This approach allows for a more accurate comparison and understanding of the company's operational efficiency. Recalculating the net profit margin after excluding these one-time effects can reveal a more representative profitability ratio. Sometimes expenses are reclassified from one category of P&L to another category, affecting how net profit margin appears. This does not change the actual performance, but may distort year-over-year comparisons. My friends, net profit margin is fundamentally a measure of management effectiveness at controlling cost and optimizing the profits. In essence, when analyzing net profit margin, always consider the broader context, including one-off items and reclassification. This ensures a fair and accurate assessment of the management performance. This comprehensive approach allows stakeholders to understand the true profitability and efficiency of the management team beyond the immediate figures presented in the financial statement. Aside from accounting adjustments, real business decisions and economic conditions also play a major role in shaping net profit margin. For example, intense competition in the market may force a company to lower its prices, thereby reducing both gross profit and the net profit margin. On the other hand, if the company has a strong brand, it allows companies to charge higher prices, boosting their net profit margin. Also, the increasing inflation or recession may adversely affect the net profit margin. For example, rising cost of wages, raw material and utilities may increase expenses and lower the net profit margin. Or if the consumer spending drops in the overall economy, the sales revenue will decline, shrinking the net profit margin. On the other hand, strategic decisions like improvement in operational efficiency, reduction in waste, or cutting off unnecessary overheads may improve the net profit margin. This is also possible that the company may invest in new technology or expansion. Now, this will increase the cost and expenses in the short term, but may lead to higher net profit margin in the long run. Alright, my friends, let's quickly summarize what we have learned about net profit margin. Net profit margin measures company's ability to turn sales into profit after deducting all operating expenses. A net high profit margin indicates strong cost control and pricing power, whereas low net profit margin suggests rising cost, inefficiencies, or competitive pressures. Changes in net profit margin should be analyzed in terms of both accounting adjustments and the real business decisions. My friends, that concludes our discussion on net profit margin. Now let's move on to another crucial profitability ratio, the asset turnover ratio. This one focuses on how efficiently a company utilizes its asset to generate sales. So far, we have discussed gross profit margin, which tells us about pricing strategy and how much profit is made per dollar of sales. Now we shift our focus to volumes, how effectively assets are being used to generate revenue, to generate sales. Asset turnover is a key efficiency ratio that measures how much sale revenue is generated for each dollar of capital employed in the business. In simple terms, this ratio helps answer the question, how effectively is the company using its assets to generate sales? Asset turnover is calculated by dividing the sales with the amount of capital employed. Here, sales is the total revenue of the company and the capital employed is the total asset minus current liabilities or equity plus debt. Sometimes asset turnover is also calculated using total assets instead of capital employed. For example, if your examiner says to calculate asset turnover based on total assets, you take sales and divide them by total assets. These are presumed to be equal to the capital employed. This means that whenever you calculate asset turnover, always check whether you are using capital employed or total assets. My friends, asset turnover ratio is typically expressed as a multiple. For example, if your calculation gives 4, it is written as 4:1. Now what does this mean? Asset turnover essentially indicate how much sales have been generated by the business for each dollar of capital employed. So asset turnover of 4:1 means that for every $1 of capital employed, the company generates $4 in sales. If the ratio comes out as 2.3:1, it means that for every $1 of capital generates $2.3 in sales. Logically speaking, a higher asset turnover is preferred because it indicates that assets are being used efficiently to generate revenue. For example, if a company has $100 in capital employed and generate $500 in sales, its asset turnover is 5:1. This means for each $1 of capital, the company generates $5 in revenue. The higher the sales you are generating, the better the chances are that you can turn the business into a profit. So the higher the number, the better it is. My friends, asset turnover basically reflects the impact of volumes. It tells us whether sales volume have increased or decreased over time. For example, last year asset turnover is 1.5 and this year asset turnover is 2. This means that sales volume have increased, which is a positive indicator of business growth. Remember, just as gross profit margin tells us about prices, asset turnover specifically informs us about volumes. These two ratios are interlinked. One focuses on prices and the other one on volumes, and both are essential for generating profit from your business. My friends, asset turnover fundamentally assesses how efficiently we are using our assets to generate sales. The principle here is the higher, the better. But it's important to note that the asset turnover should not be excessively high. For example, imagine that your asset turnover ratio is extremely high, let's say 8:1. At first glance, you might think, wow, for every $1 of capital employed, we are generating $8 of sales. That's amazing. But hold on, this could also be a warning sign. A high asset turnover may indicate that the company is overtrading, the company is overutilizing its assets beyond sustainable limits. And this can lead to rapid asset depreciation. Rapid depreciation is problematic because it can lead to faster wear and tear of our plant, machinery and equipments. Rapid depreciation of asset increases the maintenance cost and the need for premature replacement of assets. Also, the quality of operation may deteriorate due to excessive pressure on resources. So while a high turnover is desirable, it should not be excessively high compared to the industry benchmark. Ideally, your asset turnover should be close to or slightly above the industry average, perhaps 10 to 20% more, but not so high that it indicates overutilization of your assets. Overutilization of assets can compromise the overall quality of the business, affecting the long-term operational capacity. Alright, my friends, let's discuss a crucial interconnection. Gross profit margin relates to prices, whereas asset turnover relates to volumes. These two ratios have indirect relationship with each other. If prices increases, sales volume may decrease, and in this case, asset turnover would be lower. On the other hand, if prices decreases, sales volume may increase, but the asset turnover would be higher. So what is the best scenario? Should business focus on prices or volumes? Ideally, they should focus on both. The optimal strategy is to increase prices and sustain volume in such a way that the overall return is maximized. This is the best outcome a business can aim for. Therefore, in scenarios where GP margin is increasing, asset turnover is likely decreasing. When answering exam question, you may need to make a correlation between these elements and explain this to your examiner. Consider a scenario where both GP margin and asset turnover are increasing. This combination is the most favorable outcome. If the GP margin is rising, it means prices are being increased. And if asset turnover is also rising, it indicates that sales volume are increasing as well. This scenario would suggest that the company is in a market leading position, commanding higher prices while also achieving higher sales volume. This is indicative of a strong market presence and can lead to substantial returns from your businesses. Another key point to remember is that asset turnover varies across industries. Like low asset turnover is common in capital intensive industries. Industries that require heavy investment in plant and machinery, real estate or infrastructure such as manufacturing, oil and gas or telecommunication. These industries tend to have lower asset turnover because they have high capital employed but generate steady long-term revenue. On the other hand, high asset turnover is common in low-margin businesses like retailers, supermarkets, and fast food chains such as Walmart, Amazon, or McDonald's. They have high asset turnover ratio because they operate on low profit margin but sell large volumes of goods quickly. So the key takeaway is that if you are analyzing a capital intensive industry, expect a lower asset turnover but a higher GP margin. But if you are analyzing a retail or service industry, expect a high asset turnover but a lower gross profit margin. Alright my friends, let's summarize what we have learned about asset turnover. Asset turnover measures how efficiently a company generates revenue from its capital. A high asset turnover is good, but an excessively high ratio can indicate overutilization of asset. GP margin and asset turnover have an inverse relationship. Balancing both is the key. Also, the type of industry matters the most. Capital intensive industries tend to have low asset turnover, while retail and fast moving businesses tend to have higher asset turnover. My friend, that's wrap up our discussion on asset turnover. In the next session, we will combine everything we have learned so far and discuss return on capital employed, in short, ROS. So are we clear on asset turnover? Great. Alright, let's move forward. My friends, whenever we talk about profitability ratio, the most important ratio that you can think of is the return on capital employed. Return on capital employed, or commonly known as ROS, is a very important ratio. It measures the profitability of a company in relation to the capital invested in the business. In simpler terms, it shows how effectively the company is using the capital provided by investors, both equity and debt, to generate profits. Alright, let's break down on how to calculate return on capital employed. The formula is pretty straightforward. You start with profit before interest and tax in the numerator, and then you divide this by the capital that has been employed in the business and multiply the result by 100 to convert it into a percentage. Now, here we have two methods to calculate capital employed. The first method is the total assets minus current liabilities. This is a common method where you simply subtract your current liabilities from the total assets. And the second method is equity plus long-term liabilities. Here you add up equity, which includes share capital, share premium, and all the equity reserves, and the long-term debts and the long-term liabilities. Essentially, capital employed represents the total funds invested in the business by both equity holders and the debt holders. My friends, understanding return on capital employed is crucial for any business, especially those that are ongoing concern, that are running businesses. Investors, whether equity holders or debt holders, provide funds to the company in terms of capital being employed. And what they really care about is how much profit the business makes on the capital that they have provided. The return on capital employed ratio provides a clear picture of returns earned on the invested capital. It tells investors how effectively their money is being used to generate the profits. It's not just a number, it's a measure of efficiency that helps investor make informed decision. A higher return on capital employed generally indicate better profitability and more efficient use of resources. Alright, let's discuss some important points about return on capital employed. First of all, remember, return on capital employed is the primary indicator of the business profitability. It's a tool for assessing how effectively a company is utilizing the capital invested by both equity holders and debt holders to generate profits. Think of it this way. Return on capital employed essentially tells you the return you are getting on every dollar invested in the business. If someone asks me, sir, what is the most refined ratio to determine whether a company has performed well? I would always point to the return on capital employed. Essentially, If return on capital employed is good, the company's performance is likely good, and if return on capital is poor, well, it's a red flag. So the entire essence of the business success can be determined using this single ratio. And the whole idea is that wherever you are trying to appraise a going concern or running business, return on capital employed is the most primary indicator of profitability. Through this, you can essentially conclude if the company has performed well during the year or not. However, it is important to remember that return on capital employed is a strategic measure, not an operational measure. It is a strategic measure. It does not dig into the day-to-day operations, but rather provides a snapshot of the overall business health from the high-level perspective. It's a high-level overview of whether the company's management has made effective use of the invested capital to generate profits. For example, if we compare the return of capital employed from this year to last year, say it is 20% for this year and 15% for the last year. At first, you would say, all right, we are doing better this year. But return on capital employed won't tell you why it is better. It only shows that it is. It's your job to dig deeper and understand the strategic moves behind these numbers. So when you are analyzing a company, especially one that's running smoothly and is considered a going concern, return on capital employed becomes your easy tool to understand if the company is performing well or not. It answers this simple question: from the capital we have invested this year, how much profit did we manage to generate? My friends, return on capital employed is a strategic measure. It can also be used to compare your company with other companies. Let's say you are comparing your company's ROS with the ROS of your competitor. If your company's ROS is 10% and your competitor is at 8%, at first you are performing better, at least on the surface. It may be due to effective management, better cost control, increased sales, or any other factor. Additionally, ROS can also be used to compare your company with the industry averages or the industry benchmark. Let's say the industry average of ROS is 15% and you are at ROS of 10%. Now this indicates underperformance relative to the industry. There is still some room for improvement. The whole point that I am trying to make is that you never go into the nitty-gritty of profitability or operations when discussing growth. ROS is a strategic measure, a strategic ratio, and therefore it requires strategic comparison. You compare this ratio with other companies, with the target return on capital employed that you have been provided, and with the industry averages. But you do not dig into the basics of profitability. That's not the objective of calculating return on capital employed. Here is a critical point, my friends. Always base your analysis of return on capital employed on controllable factors. This is crucial when appraising the performance of the company's management and its board of directors. It would be unfair, it would be misleading to assess the company's management and the company's performance based on factors that are outside their control. Assessing their performance based on uncontrollable factor is pointless. Therefore, it is very important to use controllable factors for the purpose of performance appraisal. Let me clarify this point with an example. Suppose a company had a gross profit of $10,000 and it suffered a one-off disposal loss of $5,000, resulting in a profit before interest and tax of $5,000. Assume if their capital employed was $50,000, their return on capital employed would appear to be 10%. However, here you need to assess the company's performance correctly. Here, it is quite evident that the profit and loss account includes a one-off expenditure. You cannot base the appraisal of your management or the board of directors on a one-off expenditure. This one-off expenditure may have been due to impairment, or perhaps the machinery was ideal and they decided to sell it even at a loss. They might have wanted to ensure they have enough space in their factory to run operation smoothly, or to get the optimum price for their ideal machinery right now, rather than risk for further losses in the future years. This may have been a good decision. Therefore, you need to consider that this is a one-time loss and won't continue into the future. You cannot appraise your management performance based on one-off expenditure. If I had been in your place, what I would have done is, I would add back this one-off loss to profit before interest and tax, and then the adjusted profit would be $10,000. This would reflect a much healthier return on capital employed of 20%. This would give you a more accurate picture of the company's underlying profitability and allows for a fairer assessment of the management performance. This kind of insight is crucial in exams and in real-world analysis, highlighting the need to look beyond the surface figures. In a sense, while return on capital employed is straightforward, it provides a valuable strategic overview of the company's profitability. Its strategic application requires deep understanding and careful consideration of the context. It is important that you appraise the performance of your company based on controllable factors and not on uncontrollable factors. Return on capital employed is a robust tool for comparing performance year over years, against competitors, and against the industry benchmark. But it must be handled thoroughly to ensure that the conclusions drawn are both fair and useful for making strategic decisions. Moving on, when you are appraising performance through return on capital employed, there are several factors to consider. Now, there are some accounting adjustments and genuine business reasons that can significantly influence the return on capital employed. And it's very important to differentiate between the accounting adjustments and the business reasons. Sometimes the return on capital employed is not so impressive simply because there are some accounting adjustments that have been made into the financial statements, which can adversely affect the performance of the company. And sometimes there are genuine business reasons why the company did not perform well, for which the company's board of directors or the senior management is to be held accountable. In your exams, you need to consider both of these angles. Let's first discuss some of the accounting adjustment, some of the accounting factors that you need to highlight while solving your examination question. For example, if your profit and loss contains a significant fair value gains or losses, this could impact your profit before interest and tax. For instance, if there are high fair value gains included in your profit before interest and tax would be higher, which would result in a higher return on capital employed. In this scenario, you could comment that the return on capital employed was essentially higher due to these fair value gains. However, if you exclude these fair value gains, the underlying performance may not be as good as it appears. On the other hand, if there are heavy fair value losses, you could argue that excluding these losses would have shown a higher profit before interest and tax and higher return on capital employed, indicating a better fundamental performance than reported. Whenever you are analyzing a scenario, it's crucial to identify any such anomalies. Take for example a scenario where there is a significant research and development expenditure, and it might lower the return on capital employed in the short term. You can easily comment that the R&D expenditure which was expensed out during the year has diluted the return on capital employed. However, if these research and development investments led to a successful product development, they promise future economic benefits, thus potentially improving the return on capital employed in the long run. today's research and development could yield future economic benefits. Thus, you can build a case in your exam that due to this research and development expenditure, the profit was low, but the future looks promising. You can incorporate this perspective in your interpretation. Be mindful of the recognition of leases. As with the adoption of IFRS 16, most of the leases are now recognized as finance lease. For instance, if a company enters into a lease agreement just before the year end, this would increase the capital employed without immediately contributing to the profit of the company for that year. Therefore, there would be a minimal or no impact on the profitability, but a substantial impact on the capital employed, thus affecting the return on capital employed. If you encounter such a scenario in your exam, highlight how this timing affects the ROS calculation. Then, there can be first-time revaluation of property, plant and equipment during the current year. So, if there is an upward revaluation during the year, your total assets would have increased and therefore your capital employed would have increased too. Additionally, this upward revaluation would trigger excess depreciation and this excess depreciation would dilute your profits. Both of these would typically decrease your return on capital employed. These are the type of accounting adjustments that you should always be ready to refer to when writing an examination answer. Always remember that when you are writing an examination answer for ratio analysis and interpretation, you should use words like maybe, can be, could have been. This language indicates that you are considering various possibilities based on given data. These terms are crucial because they indicate that these are possible or probable causes for such deviation. In your exams, you are not dealing with a real-life company. You don't have access to real-life data or enough time to thoroughly analyze such data. What you can do is choose the right words to convey potential explanation. These words, maybe, can be, could have been, imply that your analysis is based on limited information provided in the examination question and there is no certainty about that. But at the same time, it is also necessary to base your answer on evidence presented in the question and not just theoretical knowledge. One common mistake I often see in the exam response is the overuse of conditional language like maybe, can be, shall be, or could be. While these terms are useful to indicate uncertainty, you must also provide evidence from the provided material to support your claim. You must demonstrate that you are not just speculating, but making educated guesses based on available data. For example, if you propose that return on capital employed has fallen, perhaps due to leases, first confirm whether the balance sheet shows any non-current lease liabilities or not. If the financial statements don't indicate any new leases, then suggesting that the return on capital employed might have decreased due to the impact of lease recognition is pointless. You won't receive any marks for that because there was no indication in the question about the new leases. Avoid making unsubstantiated claims. Always ensure that your assumptions are supported by hints or evidences provided in the exam material. Otherwise, your answer may appear speculative without reasonable basis. Therefore, it is important. Do not invent reason for changes in financial ratios. Instead, you need to trace specific accounting transactions or balances that led you to make an assumption about what might have happened. However, if you don't find any indication in your question, avoid inventing scenarios by yourself while writing your answer. For instance, if there is nothing mentioned about research and development in the entire question, there is no justification for writing that the return on capital employed may have fallen due to research and development expenditure. Writing such a statement without any hint from the question can damage the credibility of your analysis. Focus on analyzing and interpreting the data that is actually presented. Always link your response to the evidence available and consider both accounting and broader business factors to provide a comprehensive answer. This approach not only strengthens your arguments but also demonstrates a thorough understanding of various elements can impact financial ratios like return on capital employed. Alright, let's now shift our focus to the business reasons that might influence the return on capital employed. When you are analyzing return on capital employed, especially in your exam, it's crucial to understand the business dynamics that could be affecting the financial figures. For example, competition can be a major factor that can adversely influence return on capital employed. In highly competitive industries such as fashion, automobile, technology companies, they might face pressure to reduce prices or increase their marketing spend, which can suppress your margin and reduce the return on capital employed. Always check the exam question for any indication of increased competition or hints about the industry competitive nature. For example, if the question states that the company is in the fashion industry, it's reasonable to assume that intense business competition might be impacting the financials. Next, think about the broader economic environment. An economic boom can lead to higher return on capital employed, since the capital employed is now yielding higher returns due to favorable market condition. On the other hand, return on capital employed might decline during economic recession or economic depression. It's essential to correlate the economic conditions discussed in the exam scenario with the changes in return on capital employed. You need to consider factors beyond the company's management control. If you identify elements that are beyond the control of the entity's management, point out that these were the major contributing factors to any changes in return on capital employed. For instance, if regulatory changes or macroeconomic shift have occurred, these could significantly impact return on capital employed. These uncontrollable factors should be considered when appraising the company's performance. Look out for any recent acquisition or disposals mentioned in the exam question. Such transactions can have significant impact on the financial statement. Acquisition can often bring cost associated with business combinations, which are charged to P&L and could dilute profitability for the year. Similarly, the disposal of subsidiary or an asset might create a gain or losses, which is typically a one-off impact. Adjust these effects to calculate a more controllable return on capital employed. So when you encounter a question involving return on capital employed, start by assessing whether it's increasing or decreasing. Your next step should be to analyze whether this trend will continue. Identify the potential reason for changes in return on capital employed, considering both accounting factors like risk recognition, revaluation, research and development, etc., and business factors such as competition, customer perception, etc. Integrate these insights and craft your answer accordingly. This holistic approach will help you address return on capital employed comprehensively in your exam response. Alright, my friends, that's conclude our discussion on return on capital employed. My friends, now that we have covered all the profitability ratios, gross profit margin, net profit margin, asset turnover, and return on capital employed, let's take a step back and look at the bigger picture of how businesses generate profit. Ultimately, profitability revolves around two fundamental elements. One is prices, that is how much a company charges for its goods or services, and number two is volumes, that is the number of goods and services a company sells. Understanding these two elements is crucial because profitability is not just about one or the other, it's about the balance between the both. The pricing strategy of a company directly affects its profit margins. If a company sets higher prices, it generally achieves higher margins. But there is a risk of losing customers if prices are too high. And if a company sets lower prices, it may attract more customers and increase sales volume, but this might reduce profitability per unit sold. Now, net profit margin tells us how much profit the company makes after covering all the expenses. A high net profit margin suggests that the company has strong pricing power or the company has kept cost under control. Whereas a low net profit margin suggests that the company is struggling with cost or the competitive pressures are forcing lower selling prices. Thus, the pricing strategy plays a key role in determining how much profit is left after all the expenses. The second pillar of profit generation is volume. Even if a company has low profit margin, it can still make a lot of profit if it sells in high volumes. And this is where asset turnover comes in. A high asset turnover means that a company uses its assets efficiently to generate sales, whereas a low asset turnover may indicate inefficient asset utilization or over investments in asset. For example, if a company has low margin but very high sales volume, it can still be highly profitable. Think about supermarkets. They work on very thin margin, but their high sales volume make them hugely profitable. On the other hand, luxury brands work the opposite way. They sell fewer products but at very high margin. Alright, my friends, now comes a very important formula that connects everything that we have learned so far. When you multiply the net profit margin by asset turnover, the resulting product is return on capital employed. In this formula, sales figure in the numerator of the asset turnover ratio and the denominator of the net profit margin ratio cancels each other out. What remains is the profit before interest and tax from the net profit margin and the capital employed from the asset turnover multiplied by 100 due to percentage from the net profit margin. This relationship proves that return on capital employed, that is a critical measure of profitability and efficiency, is essentially the product of managing both margins reflected in net profit margin and volumes reflected in asset turnover. A company demonstrating strong performance in both matrices will likely report a robust return on capital employed, indicating healthy returns on the capital employed. However, margins and volumes are usually inversely proportional, inversely related. If you increase prices, margin will improve, but sales volume may drop because customer might switch to cheaper alternatives. And if you lower prices, sales volume may increase, but profit margin shrink, affecting the overall profitability. So the real challenge for business is to find the optimal balance between these two elements to maximize the return on capital employed. The ideal benchmark for any business is to manage prices and volumes in such a way that maximizes return on capital employed without compromising competitive positioning or market share. Achieving this balance is crucial for long-term sustainability and growth. Alright, my friends, let's summarize everything we have learned in this lecture. Gross profit margin focuses on product profitability, the difference between the selling price and the cost. Net profit margin measures overall profitability, reflecting how much profit remains after all the expenses. Asset turnover measures how efficiently a company generates sales from its assets. And finally, return on capital employed, the ultimately profitability ratio that shows how well a company utilizes its capital to generate profits. Remember, both margins and volumes contribute to profitability, and finding the right balance between prices and volume is the key to maximizing the return on capital employed. My friends, profitability ratios are at the core of financial analysis. Every company, investors, and financial analysts closely monitor these ratios to evaluate the business performance. If a company has strong profitability ratios, investor will be attracted, stock prices may rise, and the lender will be more willing to provide financing. On the other hand, if profitability ratios are weak, it could indicate deeper issues, inefficient operations, poor pricing strategies, or declining demand. So the key takeaway is that profitability is not just about one ratio. It's about understanding the connection between margins, volumes, and the capital efficiency. If you truly understand this relationship, you will be able to interpret financial performance like a professional analyst, whether in your exam or in real-world financial analysis. Alright my friends, that concludes our lecture on profitability ratio. I hope you now fully understand how gross profit margin, net profit margin, asset turnover, and return on capital employed come together to form a complete profitability picture. In our next session, we will move on to the next category of financial ratios. Until then, keep learning and keep practicing. Thank you.